Hi, everyone. Welcome to From the Research Chair. This is episode 5. We're going to be discussing most misunderstood investment concepts. Fair value. Last time we asked folks to vote on what they wanted to hear from us. The bit after the colon, the part after most misunderstood investing concepts, we chose because some of these subjects, which we'll be discussing with you, deserve, we think, a whole episode. And of course, that's Michael Falk, who's joining me. Michael, hi.
Hello, Jason. It is Antagonist Day.
Tail pulling day. Tail pulling day. So I consider fair value one of the foggiest concepts in all of investment management, which is ironic because so much of the industry sort of revolves around it. But Michael, everyone understands fair value, do they not?
Well, to use a very formal word, Jason, to say that everyone understands fair value, I'm going to say poppycock. How about that? So let's just have a little fun with words, may we? So the word fair, we've got, 13 people on this call? I dare say all 13 of us could not come to an agreed upon definition of fair. Value? Really? We're going to talk about an agreed upon perspective or definition of value. Folks, let me just break your hearts if I can try. If everybody agreed on value, there would be no trading in any investment markets. There would be no need to trade. You would not have a job. Let me just say it that way. So by putting these two words together, fair and value, we don't improve upon it. We don't get them canceling out as if two wrongs make a right. There's no such thing.
Dare I say that's a fair point?
You dare.
Well, yeah, this is one of my pet subjects, as Michael knows from our work together, working with investment teams. I hear fictions around fair value, which we're going to be discussing today, repeated all the time. And it doesn't matter the venue. It's investment teams themselves. It could be layperson investors who are a little bit more sophisticated. I see it on television. In fact, I remember being in, of all crazy places, Kazakhstan last fall and was watching the business news for Central Asia, and some portfolio manager was talking about fair value, and they just blew the concept, and they committed one of the things that makes my hackles go up. In any case, let's put up our first poll today. I think I've got the polls right finally. Oh my God. Let's see if in fact that's true. Here's the first poll today.
Fifth time is the charm, Jason, since this is our 5th episode?
I seem to be incapable of figuring this out. Fair value and target price are the same thing. Yes or no? Six responses so far, 7, 8.
No, now they're flooding in, and everybody is agreeing.
I know, right?
You know what that means? That at least I'm going to have to take the opposite side.
10, and I'm going to guess my mom didn't vote because she's here for rah-rah and spirit. So I'm going to, Michael, you can see that. Can other people see the result?
Yes, I can see it. Are people able to see
there
or show? No, I think you have to show it. There you go.
It should be up right there. Okay, perfect. So 11. Well done, everyone. I would agree that that is the correct answer. Let's talk about that. So fair value does not equal the target price. Target price is this bizarre thing that came from the sell side. Who knows when? It could be in the 20s, the teens. I don't know what part of the 20th century this concept was launched.
You mean it was created to sell us something, Jason?
Hey, you just stole my thunder. That's exactly what I was going to say. Because one of the primary issues I have with target price being confused with fair value is it implies an action, right? Embedded in the target price concept is that we're supposed to do something. After all, we've achieved the target, and ergo, you're supposed to call up your investment banker type or your trading desk at the investment banker and execute some trade. So that's one irritation. Michael.
Now, Jason, would that bring bias into the equation? Because if it was supposed to induce a trade, that means that they get paid again because they get paid on trading.
Huh. That's very mysterious why they would have this.
Maybe there's a conflict in there.
Yeah, maybe there is a conflict. So other issues that I have with it. One, it could become the thing that dominates investment conversations about a particular security. It could be a fixed income security. It could be an equity. It doesn't really matter what the security is. But if you have a target price in mind, it tends to occupy people's discussions around things. Instead, the conversations ought to be about the likelihood that you're going to be achieving some sort of reward from owning a business or a security, and the different factors that may contribute to or subtract from the probability of that occurring. So that's another problem I have with target price. Another one that I have is that time horizon is absolutely missing from target price. Presumably it's a year. I know that I've looked at many a sell side report and I'm looking in there for where's the target price time horizon, because if it renders the target price over 70 years versus 7 months, there's a huge difference in terms of my rate of return. And target price is always divorced from a time horizon concept. And then I have another huge issue with it, but Michael, you're nodding your head. Do you have something to add there?
Well, it's just such a, well, let's just call it the most misunderstood investment concept. But here's the point, right? Fair value. Let's just say if we can admit, the first step is to admit that that's in the eye of the beholder. Now, if you come up with your perspective of fair value, would it be fair, I got to have a little fun with words here, to say that that's what the security should be priced at? The world as it should be versus the world simply as it is. Now, let's be specific. When you and your investment colleagues come up with your perspective on fair value, what that means is the entirety of the rest of the world of investors, if I may use the word a gazillion other investors, obviously see it different because the price in the market is different than your assessment of fair value. How do you square that you see it differently than a gazillion other people and you're calling that fair?
Well, Michael, gee whiz, like pouring water or gasoline onto the fire. Oh my
I'm
goodness.
doing what I can, my friend.
So my next issue with target price as a concept, and as you can tell, I'm not a fan. My next issue is if the target price has not been achieved, that is market price is less than target price, is that supposed to imply a margin of safety? And I've actually quizzed people about this before, and they don't have a very good answer for it. You know why? Because target price is a confusing concept, because it's not really talking about a fair value. It's not necessarily talking about a price to buy at right now. It just smears, which is a technical term, understanding about a business. And so anyway, can we please lay to rest the concept of target price? If I had to say my biggest issue with it, it's that it embeds a decision and many people blindly follow the decision. Number two big problem is it occupies huge mental space and shuts down discussion rather than sparks discussion.
Well, Jason, this begs a question. Would it be reasonable? I'm not going to use the word fair anymore. I'm lying now. Would it be reasonable to use target price if the securities markets were going to close down for the next 1 year, 5 years, 10 years? If time was essentially going to stop in terms of liquidity, would target price be fair?
If it were down, sure, but it never is. It's a little skewed toward the positive. So, Michael, you said we can't come to an agreement on what fair is and what value is.
Yeah.
I won't put you on the permanent record. This is not stone here. This is not a chisel. This is just a hypothetical. What's your working definition of this concept?
Of fair value or of target pricing?
Fair value. Well, target price is burning on the embers.
My working definition of fair value is that I don't think it is fair to pay more than X for that security. That's my working definition.
Yeah, and I'll put mine out there. Also, not chiseled, not stone, not chisel.
No
Um,
tablets.
I tend to think of fair value, yes, kind of like that, but I allow room to the upside. I think if we're going to be uh, talking about fair value as an important concept in investing, we also have to allow for volatility to the upside and the idea that we may have misestimated to that direction as well, to perhaps a significant degree, but we never do, right? So as soon as fair value is achieved, all of a sudden things change. So that's one thing. I tend to think of fair value as the value that comes from some sort of value estimation process. Doesn't matter what it is. Could be PE, could be price to sales, could be price to EBITDA, price to EBIT, free cash flow. Doesn't really matter what that is. Fair value is, and to me, this is the primary value, haha, of the concept. It's to spark discussions and understanding about the underlying security. It is a hypothetical number, but it's something that once rendered and estimated becomes then a discussion point. Because if you have built a model that has your best assumptions or range of assumptions embedded in it, and it naturally shakes out an evaluation model, a price, then that becomes a discussion point for what does the market got, or what does it know that we do not? What do we know that the market does not? Are we better at estimating these kinds of elements that are embedded in the model than the market? And that's the real purpose of a fair value estimate, is to spark deeper understanding into a security. And Michael, I know you have a very interesting
Well,
technique on how
yeah,
to do
and that's
this.
baked into the value that we think it would be fair not to pay above X. So yes, there has to be a mechanism to attempt to come up with what the proper price is, and that has to be a dialogue. It just has to be. If only we reference back to The Wisdom of Crowds, James Surowiecki, 2004, the book, right? The crowd is better given five tenets being met at figuring out the price or the estimate of anything versus an expert or one single team. But here's the point where we see it differently. So if I've got a winner, you know what I say about a winner? Thank you. I'm just appreciative. If the investment gods want to give us a winner, I just say thank you. What do the rest of you people do? So it gets above what you think is fair value doesn't mean I'm selling it. I may look to momentum indicators to help me understand.
Shh, Michael, you're leading the witness in terms of pull two.
Sorry, I get carried away with these silly terms.
Well, yeah, here we're going to talk about some of the embed here. This is poll two. My preferred margin of safety is less than 15%, meaning that if the value is around 15% or less, I will purchase. 16 to 30, 31 plus, one standard deviation below, two standard deviations, or something else. And if it's something else, to spark dialogue, use the chat function if you end up selecting that. Ooh, I'd like somebody went in there for one standard deviation. That's definitely in the rarity crowd. Talking about leading the witness, right?
Well, now you're biasing the vote. It's one thing to lead them, it's another one to bias the vote.
To insist upon an answer. 7 of 13 have voted. We don't necessarily have to wait for everybody, but I do
It's
want to
so
give.
interesting. They were so quick to respond to the first poll question, and they still seem to be present. Maybe they don't like this question.
Well, it could be. And by the way, I have to say kudos to our attendees for, I think, rendering the correct answer to question one. Michael, even recently, you and I were doing an embedding project, and somebody messed up and used target price in lieu of fair value in their discussion with something. And I mean, this is at the pro level. This is like high finance, not low finance that we're talking about. People do mess this concept up. So kudos to the audience. All right, we're going to call it. Oh, yeah, we've got an eighth one. Just as I was about to call it, just in under the wire. End
Yeah,
that
but
one.
listen, they came in at the most popular votes, so
They did come in at the most popular vote. For what it's worth, my margin of safety used to be 15%, but with the upper range too, the upper bound. And that captured my 30%. Margin of safety went also to the upside, so I had room to quote unquote let winners run, which is what Michael was alluding to. I think that one of the screw ups for many people with the concept of fair value is they think, hey, I may have messed up and overestimated. Well, you may have messed up and underestimated too. And properly, the margin of safety has to be a range bound number around that fair value estimate, not just fair value and below.
Yeah, and listen, because the market does not close, per my comment a little bit earlier, when you get to some plus or minus of what you would argue is a fair value, shouldn't you reassess? Shouldn't you say, hey, maybe things have changed? Because the security represents a business, and the business is hopefully a going concern. Things change in their business. So at a minimum, it deserves a reassessment, wouldn't it, Jason?
I think it absolutely does bear a reassessment, which brings me to another one of my complaints about target price and fair value as concepts. I said, I promised target prices on the bonfire being burned. So just fair value and all of its problematic features too. But with regard to the margin of safety, people frequently, they don't really think about what I said before, the range bound, but they also don't think that it's really an arbitrary thing. And it actually communicates your degree of many emotional things, your level of self-confidence and conviction, and your ability to estimate something. And fairly rendered, I think a concept of margin of safety is the price at which something has to trade for me to be comfortable. And that's an entirely different conversation. And I think once you engage in that conversation, could be a self-awareness conversation, could be a conversation with an investment team. I think that takes you many, many interesting directions, especially in a team setting. And also we're talking about what gives me comfort. And that's slightly different than the margin of safety concept, but similar. Michael,
Or,
you're nodding your head.
well, whenever I hear margin of safety, I think of a couple of things. And let's take value investors out of the equation for a moment, because that's the first thing that comes to everybody's mind and to some extent. But I'm like, why do you want a margin of safety? And, the thought is, well, I want some protection, right, on this decision. So you want protection from being wrong. That's really what you're saying. Well, if for those people, and listen, I'm not picking on you, but for those people, the 5 people who selected 16 to 30%, then do you have a reason to be confident that on average, when you check into your history and your data, that on average you are wrong 16 to 30% per security that you're valuing? And if you are consistently missing by that margin, then maybe something is amiss in your model of how you're assessing valuation.
And another point on that, complementary point, is that the margin of safety. Oh, and of course now I've lost my train of thought, and I had it. I waited so long to be polite to you and didn't express it. Um, what I was going to say about the margin of safety had to do with, yes, it gives you the comfort, right? But the other bit, oh yeah, I can't remember. I thought for sure I would be able to spark it again, but um, oh, I know what I was going to say. There's alpha embedded in there, right? That's the real concept there, is that there's alpha embedded in there, but what's invisible to you if you use the concept of margin of safety are the opportunity costs as well. If the range is too high, Michael, your point about 16 to 30, and I used 15, but it was 15 in the top, 15 below, sort of 30% range. If it's too high and the threshold of buy or not buy is too high, there's opportunity cost lurking in the background because you haven't gone in and you may have passed up any number of securities that may have in fact made you money, which brings us to our third poll. And this is a sneaky one, fair warning.
I don't know. They may prefer a sneaky poll to some of the comments we're making.
Yeah, let's take a look here. All right, there's the next one. When the market price equals my fair value price, I consider selling the security, time to reevaluate. Sell the security, there's no growth left. Let my winner run. Something else. If so, use chat.
If
Ooh,
somebody does select something else and they use chat to do that, I am fascinated on what the other option might be. So I do want to hear from you.
we've got 7 of 13. Michael and I can see it as host and
Ooh,
co-host.
it's like a horse race. Those two are going back and forth, whichever one gets the most votes. Do you think they tired out? Four people have chosen just to sit this one out.
Two of them would be you and me, and no, actually, it's not you and me. My mom is not going to vote. I'm trusting here, though she
Well,
has.
we can run. We can run with what we have. Can we
Okay,
not?
we can indeed. All right, so here we go for discussion purposes. There we go. So we have 5 with consider selling security, time to reevaluate, or let my winner run. Michael, do you want to reveal? You don't have to. One of our big embedding secrets here, or you think it's appropriate, or do you have
Yeah,
something you can add
I
obliquely here?
want. I want to listen. Our guests have put up with my inflammatory comments. The least I could do is give them something. Folks, when you think of your cell discipline, so often people think of their cell discipline in terms of what do they do with something that is causing them great pain and anguish? What do they do with something that's losing in their portfolio? To which I say, yeah, we need to talk about that. That's important. But what do you do with a winner? Do you have a cell discipline for your winners? And Jason, you've witnessed this. They're like, oh my God, that makes sense, but we've never thought about it that way. And so, listen, there's a lot of different ways to design that, but I've already given you a little bit of a tip, right? Whatever you decided to buy because you thought there was a margin of safety, you thought the fair value was greater than what the market was pricing currently, whatever the case is, all right? Bottom line, let's say you were maybe correct, meaning the security rose in price and you feel validated for your decision. That doesn't mean it rose for the reason you thought it should have, but it rose anyway. So if it rose, you feel validated, but it did not rise for your rationale, then how can you justify doing anything with it? Since you clearly did not get it right in the first place, you just got lucky. What do you do with lucky? Jason, what do you do with lucky?
You learn, you excavate the decision making and evaluate what you missed and what may be actionable and can become a part of the process for the future. So for me, the correct answer here is something else. Use chat. And the real answer, and this is why this one was tricky, I think it's just period time to reevaluate. Rather than consider selling the security, time to reevaluate. But this is especially sneaky, this one. This used to be an interview question I used to ask candidates at the Davis funds. And mostly people say, I sell the security, there is no growth left. And no one on the call chose that one. Kudos to you.
Yes.
Uh, when that happens, people are treating fair value like a target price. And in fact, they're selling out of it. And I used to work with folks. Sorry, folks who I worked with at the Davis funds committed this error in judgment. When the fair value and the market price equal one another, it means the excess return is gone, meaning that the part that the market was mispricing is gone. The alpha is now sort of equal. You could expect beta level return here. Said another way, every valuation model has an embedded growth rate, and that would then become your expectation. Excess return achieved, but that doesn't mean that you're not going to experience growth in that name. And by the way, it could mean that it, say for argument's sake, that growth rate that's embedded is 20%, and you compare it to other options, you wouldn't necessarily sell. You would continue to hold that security because the other securities that you might possibly consider investing in have lower growth rates embedded in them. Even with the margin of safety, you wouldn't purchase them. So I think the correct answer here is just time to reevaluate what to do with the capital, because again, the fair value is meant to spark discussion. It's not meant to embed a decision automatically in there. It's supposed to trigger understanding by planting a flag and saying, hey, let's discuss this, but being flexible, of course.
So at a minimum, what we're talking about is when the market price equals your fair value estimate, at a minimum, time to reevaluate, excuse me. However, let it run, baby. Ride that horse, because you know what? The winners run further and faster than any of us imagine. But here's the trick. You don't let it run blindly. Because you have a reevaluation, you maybe come up with a new target, fair value, because it's growing really well. But the point is you don't clip a winner, but you may follow the winner to see when it may start to retrace. More conversation.
Michael, you are so generous today. Folks,
I'm feeling like a giver. What can I
yeah,
tell you?
Michael is giving away some of our consulting secrets and pretty close to spilling the whole beans on it. Kudos to Michael. Michael, what else would you like to say on this concept?
Well, my biggest beef, you think maybe you've heard it. No. You've not heard. My biggest beef with fair value is whose value. Whenever you talk about fair value, that is an assessment, hopefully it's an assessment you or your colleagues made and what you judged to be fair. So now we're going back to the who. Who has made this assessment? Who has made this judgment? And if it is different than the price in the market, that thing I referred to as the gazillion other investors, then what we really need to talk about is not your fair value. We have to talk about your confidence or conviction levels and how often, excavate, to use your term, Jason, how often confidence or conviction has helped us versus maybe less so. Because the bumper sticker that I like around this concept is got humility. A gazillion other people have set the market price and you see it differently. This doesn't mean you're wrong, but it begs the question, why are you so confident that you have something that a gazillion other people don't have? Let me say that in the positive. That's saying it in the negative. People talk about the behavioral bias of overconfidence as negative, 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 negative. Au contraire, my friends, if you didn't have some degree of overconfidence, you could not operate in this business, because you are buying stuff in disagreement of the value from a gazillion other investors. So all I want to know, you have to have confidence. Do you have the right level? And that's a matter of tracking over time and excavating how well your forecasts and your work tend to be in terms of valuation.
To that point, last week I wrote a blog post for those of you on the call who read my blog at my website, jasonpaulvoss.com. I wrote about overconfidence, and one of the ways of doing this, and Michael, I've been meaning to have a conversation with you about this. We should add this, I think, into some of our advice rendered to folks, when evaluating and rendering that confidence level or that conviction level, ask that person, that analyst, to say, what's your 90% confidence interval, right? And say, put a range bound around that, and then gather the data to see how accurate they are. And that then becomes a feedback loop to get better at estimating and, either growing your confidence or dialing it back. And it becomes a very true measure of what the real level of confidence is and whether it's accurate or if it's misplaced.
Yeah, it's so interesting because, and Jason, I wanted a link so you would talk about your blog post. But isn't it so interesting we talk of overconfidence as a negative or potentially damaging bias, and nobody talks about underconfidence? No, we want the right level of confidence because we know it's necessary. And we know to make a market, we need variant perceptions out there, that people who see things differently. We just want to calibrate to make sure that you are placing the best bets you can to the extent you are able.
Well, I think we're at the end of our discussion. Let's open it up for questions. You can take it off mute if you prefer, or use the chat function. It doesn't really matter. I think chat works best when Michael and I are talking, because that way we can address the questions and they might come up in the outline that we have. But at the end of our discussion, I think opening the mic up makes sense.
Yeah, I like opening the mic up. And if you're so willing to do so, maybe turn your video on too, and so you can ask the question directly, if you have one. Again, Jason, we need the Jeopardy theme. We need to play the Jeopardy theme in the background.
I have wanted for years and years a keychain that plays favorite themes, right? Like the buzzer from Tic-Tac-Toe back in the day, from Family Feud, when you get an answer wrong, would be one potentially.
This now nobody's going to ask us a question because of that reference.
Because they're afraid of the third X, the third strike. Well, I don't see any questions there. Michael, would you like to transition to the thing that irritates you that perhaps irritates nobody else?
Jason knows I've been struggling with this concept, but I need to.
Michael, you express pet peeves to me all the time. I thought this was so a layup.
It was. You know what? I'm losing my pet peeves. I don't know what that says about me. My argument is I'm becoming more gracious as I get older. Jason, you go first.
One that irritates me, and it's germane actually to the conversation today. I mentioned it earlier, and this is why I've selected it this week. Arguments over form rather than substance irritate me. Ideally, if both have been defined well regarding a concept, both the form of something, the definition of something, and the substance of that definition are in alignment such that they blur, it's not even useful. But when people talk about target price and they begin arguing about what's the correct target price, that's a misguided conversation. It's really about the substance. What is it that the target price represents? That's the end of a process to many people. In fact, I consider it the beginning of a process, and that's a process of understanding. So that's my example of people arguing form over substance. And Michael, if you don't have one, we forgot to mention something with regard to fair value.
What did we miss?
That both you and I advocate for winding the process backwards.
Oh, yes, that is a big miss.
Yes.
That is all right. So folks, because I keep poking at you and I keep talking about trying your best to see the market as it is, not what you wish or think it should be. Well, the best way to do that is you've got your model, however you try and assess and calculate value. All right, let's work backwards. Stick in your model the actual price in the market you could buy it at right now, and work backwards and see what it does to your assumptions. And now start just asking yourself, is that reasonable? Is it reasonable for the growth rate inputted to be 37% a year for the next 6 years? And if you think not, then maybe the market price may be a bit overvalued. But First step, really simple to do. Wonderful reality check. Use the market price and work backwards.
Induction and deduction. Oh my goodness. Yeah, in my own career, I would frequently look at the market price and do exactly as you have said, Michael, and then figure out where the sensitivity was within my valuation model. So, in other words, are my revenues too high? Are my cost of goods sold too low or too high? And work through and try to identify which of those assumptions I could stomach changing to get the price to be and agree with the market price. That frequently was very interesting. And it revealed, actually, we were talking about confidence earlier, frequently would highlight that I was in fact confident, because if there were a particular number where I really disagree with the market and I had good substantive reason for it, it would in fact give me confidence that my version of reality was correct. So this is another valuable technique, I think.
Jason, thank you for the reminder.
Yes. So I don't see any other questions. Michael, I'll let you off the hook now that you are kinder, gentler Michael Falk. Well, it's ironic, right? You've actually expressed a bunch of pet peeves today, but apparently you feel that other people share those irritations.
Or they should.
Or they should, right? Exactly. So with that, let's say a couple things. One, go to our YouTube channel from the Research Chair. Past episodes of it are there. Please share this more widely. We would love to get more people watching it, though we are continuing to receive each week very kind emails. We got one from a CEO, I think, of an investment firm this week, who said that he'd watched all 4 episodes and loved them. So
He binged us.
binged us, he did. And
That just seems so wrong.
we're super enthused that the average listening time for our videos is, Michael, have any guess, over under?
I'm not going there. I am always wrong.
12 minutes, 12 and a half minutes. It's holding steady at 12 and a half minutes, which is unheard of. So the people who are listening to this apparently are finding value. Thank you. We're glad you're finding value in these discussions. The next time we're also going to be discussing on the 3rd of September, same time, 12 Eastern here in the States, most misunderstood investing concepts, risk.
It's a 4-letter word, and we're going to spend time talking about it.
And this talk about passion for both Michael and I. We think that the whole business screws this up much more than they do fair value. Yes. Anyway.
Men and their math. We need to have a chat, people.
Thank you so much for joining us. We'll see you in 2 weeks. The invite will come around. If you want to share this invite, please do so, or have them send us an email and we'll add them to our distribution list. Until next time, everyone. Bye.
Bye for now. Cheers to everybody. Bye-bye.